Let me explain two important aspects of the calculation of cost of capital. So the first issue we need to be careful about is going to be, are we calculating the historical cost of capital? Are we calculating the marginal cost of capital? In the cost of capital calculation, we are always interested in the marginal cost of capital. What does that mean? The cost of raising an additional dollar of capital now in the market, because interest rates do change in the market over time. We are really not interested in historical averages. We are interested what it is going to cost to the firm to borrow the money now. Second thing that we need to be careful about in calculating the cost of capital, we are really not interested in the short-term capital where the firm could borrow the money for less than a year. Here we are really talking about long-term capital, the money that is going to be with the firm for at least 5 years, hopefully longer. So it should be the marginal cost of capital and the long-term capital. All right, let me move on to the individual cost components for the cost of capital. The first one being the cost of equity. We have essentially three methods we can use to find the cost of equity. The most famous one is going to be the capital asset pricing model. This is something you have learned in one of the previous chapters. So how do we find the cost of equity here? Cost of equity is going to be the same as the return on stock. We also refer it to R sub I being another stock I, equal to the risk-free return plus market return minus the risk-free. And we have another name for it. We also call it the market risk premium, and then we multiply it by the beta of the stock. And this is going to give us the fair return on the stock. That's what investors are going to be demanding for the firm. This is a competitive rate of return. A second model we can use to find the cost of equity really comes from the dividend discount model. Again, it's the concept of fair return. So you may think, if you invest money in a stock, what are really the two ways you're going to be making money from that investment? The first way you can make money from a stock investment is going to be, if the firm is going to be paying you dividend, we call it the dividend yield. Second obvious way is the price of the stock is going to be rising, and that's what we call the capital gains yield. So these two yields components combined are going to be referred to as the cost of equity or the fair return on equity. The third one is going to be more subjective. It's often known to be bond yield plus premium approach. So we look at the return being provided by the firm to its bondholder. And then we add into it the historical additional return stocks have provided over bond. And oftentimes This is going to be 3 to 5%. So in practice, most firms like to use the first one, the second one, and they may use the third one. Then they're going to be taking the average of the three. But realistically speaking, the first one is going to be the most relevant because it takes into account explicitly the risk of the investment. Second one is also relevant because it takes into account the two sources of income. The third one is somewhat more subjective, but still used in practice. So these are primarily the three approaches we use to find the cost of equity. Similarly, we can find the cost of debt. Cost of debt is going to be simply the yield to maturity of the bond. And then finally, cost of preferred, which I wrote earlier as RPS. This RPS approach really comes from here. Because one of the differences between preferred stock and common stock is for preferred, the G is going to be 0. And that's why if we apply this formula to finding the cost of preferred stock, it is going to be the dividend on the preferred rather than on the common by the price of the preferred, and then 0. So these are really the three approaches we use to find individual cost components. Once we have estimated this one, and this one, then it's really a matter of taking their weighted average. And that weighted average is what we call the cost of capital, and that's why earlier I wrote it as the WACC, or the weighted average cost of capital. That should do it for the cost of capital calculation. Thank you.